Well, hello, this is Ken Himmler, and we're on to part four of how to reduce or eliminate your capital gains tax. Today, we're really going to get into something that is usually complicated for most people because you read a lot on the internet about 664 trusts, and a lot of people don't understand them. You can't believe how many people have come to me over the years and they've said, "Hey, Ken, this is just too complicated." And that's really not. I mean, over 40 years, we've done a lot of these 664 trusts, and they're really not as complicated as what most people would lead you to believe. Now, in some cases, when I was with the original firm I was with 40 years ago, they at that time used to charge anywhere between $15,000 to $25,000 to do these. And they would make it out like these things were so complicated that no one else other than them could do them. Well, the goal of creating one wealth map was to simplify things for people, to bring it all under one roof, and also just to make it affordable to do these types of transactions, these types of devices, without the complication and without the huge expense. So we're going to get into this, and I'm going to do everything I can to make this as simple as possible because it can be that simple. And a lot of people, because they get caught up in the complexity of things, they don't do it because that person that is confused doesn't move forward. So hopefully this will simplify what a 664 trust is and how you can use it to potentially benefit yourself. Hey, before we get any further, I've been getting a lot of great comments. And one of the things people keep emailing me and put in the comment, "Hey, will you let me know when the next video comes out?" Well, here's how you do it. Just go into your YouTube account and you can do the @ symbol One Wealth Map, and one is spelled out ONE, One Wealth Map. You can find the channel and then just hit subscribe, notify, and then comment. And also like it, because here's what ends up happening. The more that we get subscribers and the more that people comment, the more that like, then what ends up happening is YouTube puts that video on top, and then we get more subscribers and we can continue the production of all these educational videos that hopefully you've appreciated so far. So without further ado, let's actually get into the details of what we're going to do today. What you're going to learn? Well, this is part four of five. And in part one, I taught you how to use timing methods to potentially get into a 0% capital gains tax rate. In part two, I talked about basis laddering, how to use tax offsets and sell something to basis ladder up. In part three, I talked about pure tax loss harvesting, which again, all these videos are available on the channel. All you got to do is find the channel. And then today we're going to talk about 664 trusts. And then in final part five, we're going to talk about all the hidden taxes and how to use strategies to reduce or eliminate RMD taxes in addition to loss swapping. But today we're just going to focus on 664s. All right, tax deferral, not tax free. You hear me talk about, you're in the grocery store, you walk down the aisle in the grocery store, and usually on one side there's the candy, and then next to the candy, you have all these magazines, right? And inevitably, there's Money Magazine, there's Forbes, there's Kiplinger's, and I might be dating myself because I don't read paper magazines anymore, so I don't even know if those are still in publication or not. But also, right next to those magazines is the Inquirer. You know, famous actor abducted by aliens, right? I mean, this is what is on the grocery store aisle. But what catches my attention all the time is the front of that magazine. It's always defer, defer, defer. Advice, how you can defer your taxes more, how you can put more money away into 401ks. Why does everybody pump that up? And why do the financial advisors pump that up? Well, there's a little known secret that when you have money inside of anything deferred, whether it's stock, whether it's real estate, whether it's a 401k or IRA, there is a 75 to 90% statistical chance that you will not sell because of the tax that's due. And this is a compounding, yes, this is kind of a pun if you think about it, there's a compounding tax effect because if you continue to allow something to compound, you're compounding the tax too, because we live in a progressive tax system. So the bigger the tax is, the bigger the gain is, the more tax that you're going to pay. So tax deferral is not a great idea. Now, I've actually had people that will say, I'm going to live at a lesser lifestyle because I don't want to pay the tax and I'm going to wait to die. And in some cases, like real estate or stocks, you can pass those assets down to your beneficiaries and they get what's called a step up in basis. What that means is all the gains are forgiven. So if you buy a stock for $100 and it's now worth $1,000 and you say, I'm going to cash it in, you have $900 of capital gain. But if you leave it to your children, they get it with a new basis. It gets stepped up to the current value, which is 1,000. So I've had people actually, and I look at this and I'll say, and this is why the tagline on our website and on YouTube is, if you don't fly first class, your children will. Because over 4 decades, I've experienced this. And I'll say, why don't you go buy that boat? Why don't you go buy the RV? Why don't you take that, 6-month cruise? Why don't you take that vacation in Europe for 3 months? Well, I'd have to liquidate something and then I'd have to pay the tax and I don't want to pay the tax. And so, no, it's okay. I'll just leave it to my kids. And so people live at a lesser lifestyle. So what I'm about to teach you today has a lot to do with our mission statement and our vision of how we want to help people, which is live a better life than what you've been living by giving you strategies on how to tax efficiently handle things to have more money. Because if you don't, you're going to die and certain taxes will be paid, certainly, like on IRAs and annuities. And then you don't have the ability to utilize that while you're alive. So again, tax deferral is not always the best thing in the world. So at some point, you're going to have to pay the tax, or somebody else is going to have to pay the tax. The other question I always ask is tax deferral in every year really the best thing? I'll give you an example. Let's say you are in an effective bracket, not marginal, but effective bracket of, say, 20%. And you want to defer money to a 401k, an IRA. Let's say you want to defer money by not selling real estate because there's a gain. You want to defer money in your business because you don't want to pay the tax, so you continue to run the business. It goes on and on. It could be stock, right? The minute you sell that gain, you're going to pay the tax on it. But in those years that you deferred, was it really better to defer? I'm going to use an example of this, and this will really help you in today's discussion. Let's say you have a piece of property, and that property you depreciate. Now, depreciation, again, I promised. I know some of you are going to be like, oh, my, Ken, come on, move on, man. I already know what this means. Go faster. Well, I am trying to educate a large group of people, and I know you might be a person that already understands a lot of this, and you're just looking to get to the meat of it. Promise I will, and I go pretty fast, so just bear with me. For those of you that I'm trying to also educate, depreciation is a deduction. Here's the easiest way to do it. If I take a piece of property, and you're going to see this example in a minute, and that is $1 million purchase, I have to allocate a certain amount to the land cost. Land is not depreciable, but the concept is over time things wear down, and they do. I mean, buildings need new roofs, and HVAC systems need to be replaced, and wood needs to be treated, or it devalues itself. It's a great deduction if you know how to use it, but if you don't know how to use it, you can get really stung, because there's years that you shouldn't be depreciating. And there's, in some cases, you shouldn't be depreciating at all. Just like there are times where you should not defer tax on a capital gain on stock. You should basis ladder. There are times that you should not put into a 401k or an IRA because your tax bracket today is what you're deferring. So here's the example. If I take that $1 million property and I allocate $200,000 towards land, I'm going to depreciate the $800,000. I'm going to depreciate that over about a 28-year period of time. So the factor, meaning if you want to figure out how much that is, take 800,000 times 0.03636, call it 4%. So you get about $24,000, $25,000 of depreciation each and every year for over 27, 28 years. So when you take that deduction, you're deducting that in today's bracket. So here's the example. If your effective bracket is 20%, but when you sell that property, The government has something called a 1250 recapture. That's the section code. And what they do is when they recapture it, they recapture it at a much higher tax rate. It starts at 25%. So when you recapture it, are you now paying more in tax to recapture the depreciation than your bracket was that you deducted that given year? If so, you lost money. It wasn't a good idea. I also get this common issue when people try to defer a lot of money into IRAs and 401ks. And they're sitting there in the lowest bracket, but they're deferring it, which is why I wholeheartedly, completely disagree with the mandatory ramp up in 401ks now that Secure Act 2.0 has implemented, where they ramp in with mandatory 401k deposits, ramping up to 10%. Well, what if you have somebody that's in a 10% tax bracket and they're going to defer and they're going to accumulate all this money, and by the time that they retire and they start taking the money out, they're in a much higher tax bracket. Now, some people might say, well, they're not necessarily going to be in a higher bracket. But listen, when you're sitting on close to $35 trillion in national debt and not the revenues to pay it, how do you think they're going to pay off that debt or reduce the debt? You know, the last time we had a balanced budget with the government was when Clinton was in office, and I haven't seen it since then or before then. I probably won't see it the rest of my life, and I probably got about 40, 50 years left in life expectancy, hopefully, and I just don't see it. I don't see those numbers working out. So you have to consider the crystal ball effect of, hey, if this is where we are with the country, do I really think that tax brackets are going to come down? So my point is this: don't drink the Kool-Aid that, oh, tax deferral is always such a great thing. So again, people allow these things to defer, and unfortunately, there's mistakes made when people think about capital gains tax. Most people come to me and they'll say, oh, well, I'm only going to pay a maximum of 20%. No, 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 no. It's 20% plus NIT plus IRMA plus Medicare penalty plus a raise in bracket plus alternative minimum tax, plus you might live in a state that actually has capital gains tax. It can reach as high as 40%. So again, and when you sell real estate, that's a whole nother calculation. So even if you're successful in getting all the rest of your assets, your income to be in a low bracket, that depreciation might be a nasty bite. So let's talk about really the examples. We're going to start with real estate because real estate's a big one that we use in 664 trusts. Now, we can apply this example to stocks. We can apply it to a business. We can apply it to any property except for collectibles or precious metals or Bitcoin. So you, unfortunately, in a 664 trust, there are some prohibitions. You can't use art. You cannot use gold, silver, precious metals, hard metals. You could use an exchange traded fund that invests in gold or silver because there's a publicly listed share price, but you can't use gold or silver. So you can't use art, you can't use gold or silver, you can't use collectibles, you can't use automobiles. You can use real estate, you can use a business, you can use stocks and bonds, mutual funds, ETFs, that's fine. So we're going to use the example, $1 million piece of property. We bought it for $1 million and now it's worth $2 million. Well, we talked about the depreciation, and let's say that we're going to use the example that this person owned the property long enough that they have fully depreciated the property out. That means that they've used up all of their deduction. And so when you use up all your deduction, you're only left with what you didn't deduct, what you couldn't deduct, which was the land cost, $200,000. So here's what it looks like. You go to sell the property. Now, let's make an agreement here that you're selling the property because you want to get out of real estate. You don't want the management headaches, the risk, whatever the entailment is. I get a lot of people and they'll say, well, we have this vacation property and I want to leave it to my kids. Okay, but I don't want to manage it right now. Okay, then why not just sell it? Well, there's a lot of tax built in on it. And the other thing is a lot of people, they have these foregone conclusions that their kids really want the property. And most kids are just too nice to tell mom and dad, we don't really want it. So they end up selling, they end up not selling it, the kids get it, and then they got to deal with the cleanup, the repairs, and then the selling of it. Anyway, we're going to use this as the example that there's a $2 million gross sale. In other words, you bought the property for $1 million, you held it long enough, you fully depreciated it, and now you're going to sell it for $2 million. So when we look at how you break down how you're taxed, $1 million is taxable at 20%. Now again, it's not always just 20%. You got to be careful of that. Don't look at that and say, yeah, that's the extent of it. 800,000, which is what you depreciated, that's a whole different tax calculation. It doesn't get taxed at capital gains tax rates. That's going to be a recapture of depreciation, which is a much higher tax rate. So the $1.8 million is of additional income that you're going to be putting on your tax return. Well, that very, very well may cause a lot more tax. It very, very well may cause more in Medicare premiums because there's what's called an IRMA penalty. You can go up to an extra $12,000 a year in IRMA penalty. Could be more by the time that you watch this with what they're doing with Medicare and Medicaid. The trigger taxes are also the NIT tax, the state capital gains tax, possible alternative minimum tax. But the bottom line is you're going to increase your adjusted gross income, which then excludes you from a lot of deductions. So here's a great example. You put $1.8 million on your tax returns. You're going to get phased out of a lot of your deductions. If you have things such as medical expenses, well, 7.5% of your gross adjusted income is like a deductible against what you can deduct. So the more you stack on to your adjusted gross income, the less you can deduct in many other areas, and your bracket increases. So again, you've probably heard me say this, when the politicians, and I don't care who they are, they come out and say, we're going to lower taxes. Well, there's only been one president that I can verifiably tell you from doing people's tax returns that the taxes paid were actually less. Every other president in my 40 years has promised lower taxes, but when we do the returns, they give you something, but then they calculate the back end, which actually costs you more tax. So it's a great political stump speech, but it's not mathematically correct. So again, you have to be careful that when you create these gains, that you're not creating additional taxes or increases in brackets. So if I looked at this sale of this $2 million property is going to cost me pretty close to $600,000. It's going to hurt. That's a bite out of a $2 million sale. So what we're going to do is a 664 trust. Now, everybody's got conjecture. I mean, well, 664 trusts, the IRS has given them a hard time. Let me give you a little bit of background. 664 trusts were initiated back in the 50s. The IRS did not like them, so they ratified rules in the mid-60s. Those rules were general in nature. Through the 80s, which is when I started, up to the early 90s, yes, without a doubt, people were, well, I'm not going to say abuse. Abuse would indicate that people were illegally doing something. They weren't. They were following the laws, but because the laws were open-ended, they were just taking advantage of what was legal. I can tell you a case that I worked on back in the mid-80s. Really interesting case, though, because I'm in New York, and Buffalo, New York, and the guy comes in. He looks pretty disheveled, right? This is why you never judge what somebody looks like with their net worth. I mean, look at Zuckerberg, right? Hoodie, you never know, right? So he comes in, he looks very disheveled, dirty hands. So, of course, I'm the new guy, I'm the young guy. The management team says, hey, Himmler, you deal with this guy. So I sit down with him and I ask him, what do you do for a living? He says, well, I sweep floors at General Motors in Buffalo, the General Motors assembly plant. I said, okay. And I said, what are you here for? He said, well, I'm selling one of my properties. I said, okay, how many properties do you have? He said, about 50. And I said, what do you think your net worth is? He's about 50 million. Now, this is in the 80s. So that's a lot now, even. So I said, wow, okay. So I guess he had developed friends at his job at General Motors And he liked just going and hanging out, sweeping the floors, talking to his friends, having a social life. But when he was young, he started buying real estate, and he used the Burr method, the buy, rehab, rent, and refinance method, and he just kept building up real estate, which was great. So he had a $10 million piece of property he wanted to sell. So as we started going through it, we looked at it. Now, again, this is in the 80s before laws were adjusted, and we were able to put that property, of course, the minute management said, "Oh, well, Himmler, you're the young 20 something and you got a $50 million client, we're going to step back into this. We'll take this over from you," which is what happened. It's okay. I got to assist, and I got to see from a high level how a lot of this stuff was assembled and calculated. So basically, what the management team did is they came in, the advisory team, they came in, they built a 664 trust, they put his property into the 664 trust, he sold it, and this is before the laws were changed. He was able to take about 75% of that out completely tax free. So no tax on the sale, 75% out. Well, this is the kind of what the IRS called abuse. Again, he didn't break any laws. So in the early 90s, they redid a lot of the rules. You can't do that kind of aggressive move on a 664 anymore, but they are still very applicable in reducing or eliminating the capital gains tax, asset protection, estate tax. And it's interesting now that I even bring it up verbally, I didn't even put that into this presentation. So before we go further, let me just bring it in here because it's not anywhere in text. A 664 trust, once you add the asset to it, if you get sued, that asset is protected. Can't get to it. Nobody can get to it. I mean, it is the one of the highest asset protection vehicles you can utilize. Second, the minute you put it in, it removes it out of your estate for taxation purposes. Now, many of you might be sitting back and saying, well, under the current political environment, we don't anticipate that the estate tax limit will come down from currently about 20, almost $30 million for a husband and wife, because the proposal is in 2026 that the estate tax limit come down to 5 million back to each person. So a total of 10. So you might be saying, well, I don't have 10 million and I don't have 30 million. But if you do, this does eliminate the estate tax. And the other thing to remember is estate tax limits are only as good as the political administration that is in office, because they can change things. We've seen that over and over again. So you have to be prepared that you're not just saying, well, I'm estate tax free, because the next president that gets in, if they dump that down to, as an example, Senator Warren wanted to bring it down to 3 million. Bernie Sanders wanted to bring it down to a total of 1 million. So everything over 1 million is taxable. We're talking about couches and wedding rings and automobiles and furniture, and everything goes into that calculation. That did not happen. But with 35 trillion of debt, we have to be cognizant that those rules can change going forward and the limits can change. So hopefully now you have a backstory on 664 trusts. They're not new. There are rules to follow. Do people get in trouble with them? Absolutely, because no matter what, people are going to try to abuse things. They're going to try to wrangle around the rules. They're going to try to overvalue things. They're going to try to take advantage of them. I'm not talking about that. I'm talking about falling right within black and white rules, no gray areas of what the IRS prescribes. And they have a very extensive list of rules of what to follow to make this work. Anyway, now you have the real deal. So if you read something on, I call it Dr. Google, because everybody goes to Google now, which probably drives physicians insane, because people are getting their medical advice and they come into the doctor and they go, well, I read on the internet. We get the same thing. Ken, I read on the internet. Well, bottom line is you can read whatever you want on the internet. The IRS publication and rules are the only thing that you can depend upon, because if the IRS calls you to the mat, you have to make sure you follow the rules. You can't go in there and say, well, I was on Google and this guy said to do this. No, it's the IRS rules. Now that we got that out of the way, let's get into what the steps are. We're going to eliminate this capital gain on this $2 million property. So the first thing we're going to do, we are going to create a 664 trust. Now here's the key. Every time I talk about this, people will inevitably call me and go, Ken, I went to this symposium. You were a keynote speaker here. I listened to this on CRTs, and I want to do one on 664s. I said, okay. Yeah, I'm going to sell my house in 30 days. Can't do it. Now, if you have stock, so let's say that you bought Tesla and now you have $100 million. Yes, there's no waiting limit. We can create the 664 on Monday. On Tuesday, we can add the stock. On Wednesday, we can sell it Zippo zero waiting period. However, if we have real estate, we have a business, there's a 6-month waiting period. Now, is this in the prescribed IRS rules? No, but they've kind of given some guidance as to what would they consider a creation of the 664 under the doctrine of what's called a contemplation of sale. 6 months is kind of a safe harbor. So we're going to make the presumption we're following the rules. We're going to create the 664 within 6 months prior to any sale of real estate or a business. Now we're going to add it. How do we add it? Well, if it's a piece of real estate, it's a quitclaim deed. It just is going to transfer the ownership into the CRT, into the 664. If we have a business, it's going to be an assignment of the stock. Again, 6 months. So you set up the account, or you set up the 664. You make the transfer at least 6 months prior to the sale. And I'm also going to put a little disclosure in here. You can't list the property or the business for sale. You can't start talking to business brokers. You cannot negotiate things prior to, because again, that would be a contemplation of sale. You did this just for this. Of course you did, but the IRS says, hey, there are going to be some limits on this, and this is one of them. Okay. Again, these rules in the 6 months do not apply to publicly listed stock. So we're going to sign over the business or the real estate to the 664 trust. We're going to wait 6 months, then we're going to sell it. Okay, so again, 6 months on real estate or business. So let's look at what ends up actually happening. If we have a 664, remember, we bought the property for $1 million, right? That's the example we're using. We put 2 million, the value of the property now is 2 million. So when we contribute the property to the 664, the value is 2 million, not the million you bought it for, but 2 million. We have taken 800,000 in depreciation. That's because you've owned it for long enough, you fully depreciated it out. So your only basis, now basis is this word, of course, if you're good at this stuff, you know what I'm talking about. Basis is purchase price plus improvements minus depreciation. So purchase price plus improvements minus depreciation. So in this case, you purchased it for $1 million, you depreciated 800,000, your remaining basis is 200,000. The value of the property is 2 million. So your basis, what we call basis ratio, is 10%. 200,000 into the 2 million, 10%. Okay, so you sold the property inside the 664. Now the big question is, how much tax am I going to have to pay? Well, the good news is zero tax. How much depreciation am I going to have to recapture? Good news is zero. So let's look at the 664 structure, and we're going to fill in some of the little details, right? So first, you have to set a rate. Now, how do you set a rate? Well, this is why we always advise people to work with somebody that is independent and qualified to do this. Just because a lawyer says I can draft a CRT does not mean that they know how they work, how they're administered, or how to structure them. Just because a CPA says, hey, I can draft that for you and use it, does not mean that they know how it works. There's a lot of charlatans, con artists running around going, well, we can create a CRT for you, it's $5,000, and all they're doing is a basic template that you could probably find for free on the internet. I'm not suggesting that. Here's why. There are different types of CRTs. There's 5 different types. There's different states. that have advantages and disadvantages to drafting it. Oh, but you might say, I live in Kentucky. Am I allowed to draft a Nevada 664 or a South Dakota 664? Absolutely. There's no borders restrictions when it comes to you drafting a trust in a state that is more preferential for you. But again, this is why you should meet with somebody that's got experience and qualified in this so they can explain that to you. Many times people come, they'll say, well, I went on LegalZoom or I went and got this template online and I drafted my own 664. Okay, well, you live in Tennessee. Why did you do it in Tennessee? Well, isn't that what I should have done? That's the state I lived in. No, because certain states are not as preferable in how you can maneuver the taxation versus other states. So again, going back, just make sure you're dealing with somebody that really knows what they're doing, but go back to the 550 rule. So you can go as low as 5%. So the IRS in these new rules that they designed in the 90s, what's called a 510 rule. So the 510 rule is you must pay out 5% minimum, and by the IRS's calculations, and there's a formula that they have that sometimes you can use an online calculator or you can do it by hand, but you can go to their publication on this. 5227 is the publication, and you can read on how to compute this calculation or find somebody that's qualified to help you with it. But the bottom line is you can go a minimum of 5. It has to have a retained interest, meaning that by your anticipated life expectancy, it should show at least 10% left in it. Now, this is a big confusion. You go on the internet and says, well, you got to make sure you have 10%. No, that's not correct. You only have the first time calculation, and that's based upon your current age. So if you put all your money into a 664 and you buy some really terrible stock and it loses 100%, you have no more obligation. There's no obligation to make sure that there's 10%. It's just an initial calculation. This was designed in the 90s to curb some of the abuses. But once you pass that initial formula, there is no requirement after that. Now, how does the IRS know that you're meeting this requirement? Well, two things. One, it's drafted into the trust. So once you draft in and you say, I want 5% payout, I want 10% payout, I want 20% payout. Again, I get these comments, well, Ken, what's the best? Well, it all depends. Depends on what your total assets are. Do you want the income from the 664? Do you not want the income from the 664? Do you want to pass as much of this on to a family foundation as you can? So again, this is why it really takes somebody to interact human to human with you. That cannot be done by a computer program, a calculator, AI. They have to really understand what your objectives are, and then they can come up with different options in the calculations. So bottom line is you got to come up with some percentage. Minimum of 5, it can go up to 50 depending upon your age, but you got to come up with some percentage. Income has to be taken out the same every year, whatever that percentage is, and it's taken out at the same ratio for taxation as what you put it in. Okay, so where do we come up with this ratio? Well, here's the example. Let's say that I added the $2 million property. If you remember, we had $200,000 of basis left, 10%. Remember that number, because that's how you figure out your income tax ratio. So if I had the $1 million, I depreciated $800,000, I got $200,000 left. I put a $2 million property into the 664. My ratio is 10%. So I have, out of that $2 million, whatever the income that comes out, 90% of it is going to be taxable, 10% will be tax-free. So let's look at a summary of how the 664 plays out. So if we sold the property outside the 664, we're going to pay upwards of $600,000 in tax. Now, many people will say, you know what, I'd just rather pay the tax instead of getting into all this complication. Okay, that's a very short-sighted answer because you don't need to. When you go to see a doctor, you don't ask, how is he going to do the surgery? Meaning, well, where are you going to cut me? How are you going to clamp off my organs? How are you going to give me the anesthesia? How are you going to suture? Show me exactly how you're. No, what you do is first you have to find the expert. You get multiple opinions, not from Dr. Google, but from the doctors. Then you compare your risks, your costs, your recovery time, and then you put your trust in the doctor as a partner to work with you to get to the end result. You do the same thing with CRT. What you don't do is you don't have a life-threatening operation need and going, yeah, I just don't understand it all. It's too confusing to understand every step that the doctor is going to take. No, that's not what you do. You say, I got a problem. I got to find the expert to help me solve the problem, and I got to trust the expert. I pay the expert. I have the outcome. So when it comes to CRTs, please, I've heard people do this. I've seen it. I've witnessed it. Millions of dollars of gains, and they're like, I just don't have time to understand it. They don't understand it, and then they end up paying the tax, which is horrible if they would have just taken the time to work with somebody. So 600,000 isn't the only end result. You're going to see how it affects the income too. So if we sell inside the 664, no tax, no recapture of the depreciation. So let's take a look at the summary of the income. If I take the income, meaning I sold the property outside the 664 trust, so I didn't use it, I'm going to pay my $600,000 of tax. I'm going to walk away with $1.4 million. Now keep in mind, this is not asset protected, so if somebody sues you, they can get to it, number one. Number two, if you do have an estate tax issue, or if you may in the future, that $1.4 million is subjected to yet another tax called the estate tax. If you live in a state, so Oregon is a great example. Oregon has a $1 million max state, not federal, but state, estate tax. I say that to accentuate the E before the state, because sometimes say state. Yeah, it's a state tax applied at federal and or state levels. So that is not a good thing to have that sitting inside your estate. But we're going to make a presumption. Again, this is not a guarantee. It's not what I'm telling you you're going to earn, but I'm going to use an example. Let's say that this example says that you're going to earn 5% on your money. So we sell the property for $2 million. We give the government back $600,000. We have $1.4 million left to invest, and we're going to invest it at 5%. That's 70 grand a year in income. But again, that income is fully taxable. So now we have tax at 30%. We're using that as an example. So now you're paying $21,000 of tax on the 70 grand. So you paid two taxes. Your net income per year is $49,000. So let's do a comparison of what happens when we sell the same $2 million property inside the 664. So we have 2 million. Remember, we put the property in 6 months prior to sale. We sell the property, zero tax, zero recapture. So now we have $2 million net after sale. Now we have 2 million inside the 664. We're not going to change the investment results. We're going to presume it's the same rate of return before and after, or inside and outside the 664. So we're going to have 5% rate of return, or $100,000 per year in income. The tax-free portion is 10%. Remember, that was the ratio of the remaining basis divided into the value of the contribution to the 664. So now the taxable amount is $90,000. So we have $100,000 gross, 10%, $10,000 is tax-free. It's going to get better because I'm going to show you something else here in just a second. But you're going to have a taxable event per year of 90 grand. You're going to pay $27,000, assuming the same bracket of income tax. So your net income is $63,000. Now, let's go and compare this point by point. So on the left-hand side, we have outside the 664. You don't use the 664. Inside is on the right. Same sale of the property. That doesn't change. But on the outside, you have $600,000 of tax. Inside, no tax. Investable is $1.4 million outside. Inside is $2 million. Same rate of return. The difference in the gross income is either 70,000 or 100,000. There's zero tax exclusion on outside because it's just pure ordinary income. Inside, you still have a 10% exclusion on the income that comes out. Now, if you look at the net income on outside, you have $49,000. Inside the 664, you have $63,000. There's a $14,000 difference, but that's not really the net result in up to the first 5 years. Here's why. You're going to get a tax deduction, and I'm going to cover that with you in a minute, for the contribution. Meaning, what was your contribution? We had $2 million property. You added it to the 664. That makes you eligible for a deduction based upon your age and the current interest rates. There's a formula. So we're going to assume a 50% deduction of the contribution. You got $2 million, you put it in, you got $1 million deduction. That deduction, and yes, you can use that against anything you want. You can use it against selling other stock so you don't pay tax on it. You can use it against converting your IRA to a Roth without tax. You can use it for anything else you want. Offset just in tax on your income. Yes, you can. I'm going to make this example really, really simple. We're going to assume you're not going to use the deduction on anything else other than wiping out the tax on your income from the 664. Okay, so we're going to try to keep this example as simple as possible. So you get $1 million deduction. You're going to use the deduction against the 100,000 that you took out. So guess how much tax you'll pay? Zero, because you have $1 million deduction you're using against a $100,000 income ratio. Now, the contribution, we're going to show you how this works. Contribution to the 664 was $2 million. The assumption is 50% deduction. So if you look at somebody, say, 80 years old, they could probably get an 80% deduction. If you look at somebody in their 50s, it's probably 40 or 50%. I'm just going to use 50% as the example. It will be different. Your deduction ratio percentage is going to be different for every single person. Again, a couple things. One is it matters your age, or if you're married, joint ages. Number two is it matters what the current interest rate environment looks like. Those are factors that go into the percent that you can deduct when you contribute to the 664. Okay, so income tax year one is 100,000. I have a deduction of $1 million. I have no tax due year one. So my net income is $100,000. The deduction used is 100,000. Carry over to year two. I know I'm simplifying this. For those of you that are tax experts, you're like, well, what about the ratio on the property, the 30-20 rule? I know. Those are all things that go into the calculation. This presentation today is not to get too deep into the weeds with all we have to do in the background to compute the best methodologies, formulas, calculations. It's to explain to you that there is this option to reduce or eliminate capital gains tax and some income tax if it's used correctly. So, deduction for contribution. So it offers you a deduction when you put it in, again, based upon your age and the current interest rate. So example, if I take an 80-year-old single male, well, they're going to probably get 75% as a deduction ratio, or of the 2 million, they're going to be able to deduct 1.5. And they can use that against Roth conversions, IRA cash outs, even other stock or real estate sales. We've had people do consecutives. Consecutives mean you take two pieces of property, you put one into a 664 trust. That gives you such a big deduction, you can sell the second piece of property outside the 664 and use the deduction against it. We've had people put money into the 664 to get the deduction with real estate, and then they sell their business with no tax. So again, it really just depends on how you're going to use it. But as long as you understand, you get a deduction on the fair market value of what you put in to the 664. So if I take a 50-year-old female, then the deduction drops from, say, 75% for an 80-year-old to 25%. So again, it really depends upon your age and the current interest rates. Okay, so now here's the big biggest objection everybody has. Well, it's inside of a 664. And I went online, and Dr. Google says, but I have to give all my money to a charity. That is the most inaccurate information that people come back to us with. So let me clarify. During your entire lifetime, I got to state it again because sometimes people go back and go, so how much do I have to give to a charity during my lifetime? Let me state it again. During your entire lifetime, not a dime. Okay? I can't emphasize. This is like tattooing it or branding it or neon flashing lights. During your lifetime, not a single dime goes to any charity. It's 100% your income. That's it. Now, when the last person in the trust dies, so if you're single, you might be the last person. If you name a child, they might be the last person. If you name a spouse, they might be the last person. But the last person to die inside of that trust, then there has to be what's called a triggering event. The triggering event is, do we give the remaining amount to a public charity or do we convert it? So let me go through the first example. Let's say that you put the $2 million property in and you drained it all down during your lifetime. By the day you died, there's 20 grand left in there. That is not worthwhile to put into a family foundation. However, let's say that you put the $2 million in on Monday and on Tuesday you died. Yes, that is worthwhile to put it into a family foundation. How does it work? Well, on the date of your death, 9 months from the date of your death, you have to convert it. You have to either I say that you're dead, right? So you're not here anymore. You name a backup trustee. That could be a child, it could be a firm like ours, it could be any firm you want, it could be an individual, doesn't matter. You name a backup trustee. That trustee has to look and say, what is the best interest of the trust? There's 5 grand in there. That's not worthwhile. But there's 2 million in there. You can either create the family foundation while you are alive, or you can create it post-death, and the trustee does that. So if it's worthwhile, the trustee creates the family foundation after death. Now what happens is this. The trustee, whatever the value of that 664 trust is, they simply transfer it to the family foundation. The 664 closes out. So a year after death, the 664, unless there's any kind of appraisal issues, if there's operating companies or problems within the 664, it might have an extension, but typically it's within a year, the end of the tax year following the year of death, that 664 trust should be just closed out. Now, what happens if it goes into a family foundation? Well, if you haven't watched the movie called All the Money in the World, it's about J. Paul Getty. And J. Paul Getty was notably the richest man in the world. And he used family foundations throughout all of his life and I'm stating from what I read. I wasn't there. I can't prove he paid no income tax. I do know that, in his time, in the 20s, 30s, 40s, he was called in front of a congressional hearing because he wasn't paid any income tax, and they wanted to prove he was avoiding income tax. But he was using charitable means and family foundations, and the good news is that he never violated the laws. Now, he was in those years of abuse, no doubt, but he was able to operate and hold on to as much money as he could. His opinion, which is an opinion I share, is the less tax that you pay out, the more you can control the outcome of the value of that money. I don't know if you're in agreement with this or not, but I don't think that the government is very conscious of what they do with their money. I just read an article that the government spent $5.2 million on studying transgender conversions in monkeys. Now, I'm sorry, that is not something that if that was my business, I would approve to spend taxpayer money of $5.2 million. By you holding on to this money, you're able to control it. There is a doctrine called the velocity of money. The minute you pay tax, that velocity of money goes away, and you're unable, because the government handles it now, the government controls it, so you're unable to monitor it, grow it, or do anything with it. So the goal here is for you to be able to control it. The upside of the Family Foundation is that you can give jobs to your kids, your grandkids, and these things can last up to 360 years. Okay, hey, hopefully this makes sense. And of course, if you want some help on exploring this, you want a little bit more details, contact our office, reach out to us. We can assign you to one of our internal CPAs or one of the lawyers or one of the financial planners, and they can run the calculations for you. But before I conclude today, listen, this channel is really starting to take off, and I appreciate everybody that's sitting there subscribing, because that helps us get that work going faster, meaning production ramps up, we can get more people involved, I can create more content for you and educate you even more. So you see on your screen, just go to our channel. It's at One Wealth Map, on YouTube channel. Just hit subscribe, like, and throw some comments in there, because the more you help us with the channel, the more content I can push out there for you. Thanks for joining. And again, hopefully I've been able to take a very complex, convoluted, confusing concept down into a very simple way to understand how these 664 trusts work.